Hey guys, just wanted to upload another update to the Bitcoin Trading Journal series, and gonna post an update to a long trade I took earlier in the previous post. And I also want to take use this journal entry as an opportunity to kind of demonstrate how different time frames can operate within each other, and how they're all exerting, different effects on price simultaneously, at least in this current moment in time. And really, those are the most ideal situations where you want to be trading. So I'm going to start from the high time frames and kind of work my way down to the lower time frames. Right now, I'm on the monthly chart. What you can see here is, obviously you have your, if you even zoom out a little bit, you have this very clear uptrend, and then you have a high put in, macro high, which would be a higher high, goes into a higher low, and you get the swing high, swing low, and then you run up above this high right here, set up a higher high both on a wick and a closing basis, and then you come down, approach this higher low, and then price hits it, stabilizes, and as you can see here, this is very important. You have this as price is moving from this high down to this area, you see volatility picking up. But then once it hits that area, it stabilizes and volatility contracts, at least relative to the previous volatility. Because you can see that this price candle was contained within this price candle, and the same thing goes for this monthly candle as well. We haven't violated the highs or the lows either. Um, so you can mark that off on the chart, and work within those levels, because I do believe that's significant. Going on to the weekly chart, we can see we can see that a little bit more distinctly, right? We see, can get a better view of the distribution pattern here, the accumulation pattern here, um, and essentially, we see this level here that we're operating off. This was the previously monthly candle right here, February's candle, the high and the low. So we're sort of just oscillating within that range, but as you can see now, this is a your point of release trade. So um, essentially, price comes down to the point of release, bounces off. Now let's go down to a daily chart. You have your point of release here as well. Um, this is not the best example, because you have your point of release right here. Um, Price comes down, does offer a reaction off it, but you ultimately get this impulsive stop run here below these lows, but it never violated these lows here. So essentially, you can see how this daily point of release trade is sort of contained within the higher time frame weekly trade. And then if we go to a 4-hour chart, you have your that same type of price distinction occurring right here um, on the 20th of February. And you see price moves impulsively up, and then essentially the price comes down to this level, and operates off that level, basically offering a reaction, not immediately, but you can see it came down to this level, worked around it, kind of drawing liquidity away from the market, and then when the volatility expanded again, it sort of expanded to the upside, filling this gap in inefficiency right here. So you can kind of see how you have your monthly, your weekly, your daily, your 4-hour time frames operating with each other. And now this actually, you can take this and pull this down even to a 15 minutes. So you can see how we got price swings within price swings, and this would be your 15-minute swing. Um, you when price is coming down to this level, and essentially you've got, if you look here, when price made this explosive uh, expansion and volatility, what you see is, you see price sort of comes above these highs, closes above these highs, operates off them for a few 15-minute candles, and then really starts expanding to the upside. So there's your area of interest right there, and you can see where we sort of came back to that very same area, and we're playing off this. Um, Now you can go back to my previous trade. You can see sort of how I was framing my take profits, and ultimately my position size up in this consolidation was around 60 lot size. But now I've added 40 lot size or 40 size to that position, bring it up to 100. Um, Ultimately, just because I really am confident about this trade, just based on the way the different time frames are interacting and everything's sort of lining up in my favor, and so I feel pretty confident about adding risk to this trade. And no, although I've added risk, my initial starting position was in this area, and that was 140. So although I've added risk, I still haven't brought it up to that initial starting risk. That's kind of you know uh, the type of mentality I want to have going forward. We saw right here. If we go back to the 4-hour chart, you can see that price came up, filled this inefficiency. Not perfectly. It didn't, could have gone higher, but essentially it filled the bulk of it right here. And now if we go down back to that 15-minute time frame, you potentially have the same pattern here, kind of making an attempt to play out, right? And you have this gap of price action, comes down, hits this area of expansion. And so, here's where you're looking at the market, and at least for me personally, I've identified this as an edge. Um, you know, just a very, uh, you know, distinct probability of one thing happening over another. And I have a very clearly defined target and a very clearly defined invalidation. Um, so I'm kind of looking at this and thinking that, you know, there's a pretty decent reaction that price sort of reacts off this level, and at the very least, fills this inefficiency up here. But I also I want to broaden my horizon as well because of what's going on the higher time frames. You could see volatility start to pick up, and that's something I really want to keep my eye out on for. So, as you see here, as we marked off on the monthly, right, the monthly volatility was contracting. It's kind of hard to believe that volatility is contracting when you have 10% days in Bitcoin, but this is where we are in the market currently. You see this volatility right here, right? You know, uh, Structure started breaking here, and volatility really started to pick up here on early December. Now, I remember trading this, and you can go back here, and that was essentially the day we took out this monthly low, which is kind of the area I was using as an invalidation, at least on the high macro timeframes. So essentially, you have this uptrend, but then you have higher high, higher low, come up, breach these highs, and so what you're kind of on the lookout for here is sort of any warning that this is a swing failure pattern, and generally, you get that when you come up above the highs and then close back below. That's generally a red flag, and then when you see this low taken out here, that's your confirmation. So you can go down, and we got that level marked off in the daily. You can see that when that did happen, and this is the level I was using to manage. I had to stop here, but essentially, yeah, you can see that when that low macro low got taken out on the, you know, essentially you see the volatility really start to expand here, and things start moving very aggressively to the downside. So currently, you can say relative to that volatility expansion, um, Bitcoin is sort of consolidating, and it's not so obvious here because here. So we're looking at the daily chart. We saw that monthly low violated here, and you know volatility picked up until it hit this weekly level we identified, and then you have the daily time frame coming into collision with the weekly time frame, and ultimately what you see this change of behavior coming to the market here, and Bitcoin no longer continues its trending behavior, right, of lower lows, uh, lower highs. Instead, it starts violating the highs, right, this high here, and then running up to this high here. So you get that change of behavior. So really, it's not fair to say that volatility contracted here, but it's after this change of behavior and after this market structure that you get that market structure break, and then you get the consolidation, right? So after that happens, you run this high, and you run this high, and then you get your consolidation in the sense that this swing low and this swing high come down, defend these lows, come up, defend these highs. So you can see if you were to draw a narrowing range, this is even maybe the time you want to bust out your diagonals essentially, because I do think they are valid here. Not as like magical lines that will dictate where price goes, but just to kind of illustrate the concept of volatility drying up. And so essentially, we probably better seen on the 4-hour intermediate chart. Again, yeah, it's not perfect, but you kind of get the idea, right? So as volatility dries up and comes to the end of this range, this range really begins to represent, in my opinion, um, the ideal area where you want to take trades, right? And you want to have the mental flexibility to be able to take trades, whichever way they end up playing out. You can see here I have my stop marked off on this 15-minute swing, but you know, uh, you know, I'm a little bit biased towards the upside based on what I'm seeing in the higher time frames, but ultimately, there's no guarantee. Volatility could expand to the downside, and I want to have the mental flexibility so that if that is what happens, that say my stop on this long trade gets hit, then I can flip around and find some bias to get into a short trade and then trade that expansion of volatility if in fact it does expand to the downside. And the reason why I think this area of narrowing volatility is a great place to enter a trade is because it really it's very easy to manage risk in these scenarios, right? Because it's a very tightening range, right? I mean, price doesn't have to go very far to invalidate you, and relative to the type of the amount of distance that price can expand when volatility expands, it's a very high risk to reward setup, right? So if price breaks out, then it starts to reach for these very historical levels. Um, so you're talking about $1,000 of risk for potentially over a longer period of time. A 30 hour trade, 30 risk reward trade. Of course, it doesn't happen instantly. It doesn't play out like that instantly, but you essentially get the idea. And the other thing is that once volatility expands, it's very hard to manage risk on that trade, right? So hypothetically, let's say the market does kind of pick up volatility and break this range, right? And you get that this type of expansion, right? You have 30 price moves from 33,000 to 45,000. Say you get a 12K expansion, right? Well, that takes us from 38K, all the way down to 26K, essentially, more or less. On a percentage basis, it would be a little bit different, be up by 27, but you get the idea, right? I mean, how do you manage risk after that, right? You would have to use, it's just very difficult to do that. Um, but going back to this trade here, um, you know, I don't want to get too caught up in the high time frames. I do want to remember that this is a trade based on the 15-minute chart, albeit that it's also framed in the reference of the higher time frames. But, this is a time where I have that 15-minute chart kind of nailed down, and I've just moved progressively from the monthly down to each successive time frame, trying to use similar intervals between the different time frames. So, people ask like, well, what time frame should I use? And the time frame really doesn't matter. Price is going to have same characteristics if you're using a 69-minute chart or a 69-hour chart or a 69-day chart, um, or a 100-day chart, or whatever you're going to use. But the time frame itself doesn't matter. But I think what does matter is the intervals between the time frames. And what I mean by that is, if you're using a 5-minute chart and a 60-minute chart, the interval, if you were to divide the 60-minute by the 5-minute, the interval is 12, right? So then you'd want to use similar intervals uh, going forward. So that same 12 period interval between an hourly and then the next highest time frame would be a 12-hour chart. And then, it's, whatever, the next one would be 72 hour, or yeah, can't do the quick math on that, but whatever 12 is multiplied by that. But this is the area where you can kind of get down in the weeds, right? So as I've gone down each interval into successively lower time frames from the monthly, daily, uh, down to the 4-hour, 15-minute, and then I can get down to the 3-minute. I just sort of work my way down. And so yeah, while we hit this point of interest on the 15-minute, even if you can go down to a 1-minute chart and see the type of price distinctions that are forming there. Now, unfortunately, I'm trading on Bitstamp, which just isn't as clean as other charts. But so I'll move over to Coinbase really quick, and here you can see, even here on this 1-minute, right, as price approaches this level, there's a you could have taken a short price distinction here from 39444. We're talking a 1-minute chart, right? So it offers you a quick $100. You can pull equity off that. But ultimately, what we're thinking here is that, say I expect this, going back to this 15-minute chart, I expect a reaction here, maybe fill this inefficiency. Well, then the next area of interest here would be this area right here, 40555 roughly. If I go back to that 1-minute chart, if in the action of price reaching up on the 15-minute up to that first distinction that we identified, well, if on this 1-minute chart, that will be that would be exemplified as a entire swing, right? And then we could break it down into the similar price components that we would identify on a 15-minute or any of the higher time frame charts as well. The idea is that the time frame you're looking at doesn't matter. The distinctions are going to play out no matter which time frame you're looking at. The only difference is that, of course, the amount of time that it does take to play out is going to be different, right? A 1-minute chart, you got to be very, very quick, and you can't have the same level of expectations when you're dealing with that. So just something to keep in mind. Again, this is the journal entry, the 7th journal entry to the Bitcoin Trading Journal series. Today is March 9th, 2022. I realize I don't mention it often, but please, if you're enjoying the content, please, like the videos and subscribe to the channel. It's been really interesting and really fun doing this last few weeks. So planning to pump out some more content soon. And if you guys are interested in learning more about Bitcoin and also other assets, I know I've been a little bit focused on Bitcoin recently, but hopefully I'll move out and expand into gold, euro, equities, oil, and just kind of broaden the horizon a little bit. But yeah, anyway, I'll catch you in the next one.